we know that long-term assets are assets that a company plans to use for more than 1 year or accounting period. So the disposal of long-term assets is accounted for by three things. So there's three steps. The first is removing the book value, and this would include both the cost of the asset and the related accumulated depreciation from the balance sheet. Step two, we'll need to record the receipt of cash proceeds for the total cash received or the sales proceeds. And then step three, we'll need to recognize any gain or loss resulting from the sale or disposal. And the gain or loss is just going to be equal to the sales proceeds, so the amount of cash given or received, less the book value of the asset, which we learned previously the book value is equal to cost of the asset less the accumulated depreciation of the asset. So to record the entry of the sale, we should first increase the cash account for the sales proceeds received. Next, we'll need to increase the gain or loss for the amount of sales proceeds over or below the book value of the asset. And then lastly, we'll need to decrease the book value of the asset, which again is the cost of the asset less the accumulated depreciation. And then just a reminder here that we'll treat gains on the disposal of assets the same as revenue, and we'll treat losses the same as expenses. So this means that the revenue or expense items will increase or decrease retained earnings and will also show up on the income statement. And just a reminder that gains and losses will be reported after operating income on the income statement for the company if the sale of the asset is not part of the normal operations for that company. And then you will not separately need to show the gain or loss on the statement of cash flows, as the total sales proceeds will go on one line to the investing activities section. So let's look at example 9. We have Jack's company purchasing equipment at a cost of $40,000 on January 1, year 1. Jack's estimated the salvage value of the equipment to be $0 at the end of its useful life of 5 years. Jack's company depreciated that asset on a straight line basis, and the accumulated depreciation for this equipment on December 31st, year 3 was $24,000. On January 1, year 4, the company sold the asset for $10,000. And the question was us to show the effect of the disposal on the financial statements. So as we just learned, there are 3 steps that we need to go through for the disposal of a long-term asset. We know this is a long-term asset because it is being depreciated. So the first step is to determine the book value of the asset and remove it from the balance sheet. So book value again is equal to cost of depreciation. So cost, what did Jack's company pay for this equipment? $40,000. And then the problem tells us that the accumulated depreciation the day before the asset was sold was $24,000. And we know the depreciation is only calculated at the end of every year, so there was no adjustment to this amount. So then we have $40,000 cost less $24,000 accumulated depreciation gives us $16,000 book value. All right, so to remove the book value from the balance sheet, we go down here to our horizontal financial statements model. I already have a book value of equipment assets column. And in order to remove that, we just need to subtract that $16,000 book value. So step 2 is to record the receipt of cash. How much cash did the company receive for the sale? The company received $10,000. Because this was cash received, we will put that under the statement of cash flows. And because it is related to the sale of a long-term asset, it is an investing activity. Lastly, recognize any gain or loss. We do that by taking the sales proceeds less the book value. So the sales proceeds, as we just determined, was the receipt of cash of $10,000. The book value we also just determined was $16,000. So we have 10,000 minus 16,000 gives us a negative $6,000 or a loss of $6,000. Now losses will be treated like expenses, so on the balance sheet we must remove that from retained earnings or decrease retained earnings by that amount. Then we'll also show a loss in the income statement. So the quote-unquote expenses will increase, which will have a negative impact on net income.